Hello, welcome to the first walkthrough video for Chapter 17, where we're going to look at some entries for debt investments. So let's take a look at brief exercise 17-1, and this is on page 17-51. All right, so for this one, we have Garfield Company purchasing on January 1, 2020, a held-to-maturity investment, $80,000 of the 9% 5-year bonds of Chester Corporation for $74,086, which provides an 11% return. We need to prepare Garfield's journal entries for the purchase of the investment and the receipt of the annual interest and discount amortization. Assume the effective interest amortization method is used. So when looking at debt securities, there are 3 possible categories that we could have. We could have held to maturity, available for sale, and trading. For held to maturity securities, these are recorded at amortized cost. So we're not really concerned about the fair value. There's no write up to fair value at the end of the period. Because we are the investment holder or the bond holder, on the day the bonds are issued, we're buying them. So we're going to be paying out cash, and then we're going to get semi-annual, annual or semi-annual? It's probably annual in this one. We're going to get annual payments, cash payments of interest that we need to deal with. Instead of that resulting in some interest expense, it's actually going to result in interest revenue because we're on the flip side of things and we have the different hat on. All right, let's get started with this one. I know they gave me a date, but I forgot the date already. January 1. So on 1/1, I'm going to record this as a debt investment. So we debit debt investment. And sometimes I like to label it as HTM for held to maturity or AFS for available for sale, but that's not necessary. It is helpful when you classify your securities on the balance sheet to know which ones are held to maturity and available for sale. But typically these are all long-term. If it's trading, it's going to be shown in the short-term investment section of that balance sheet. All right, so we're going to record this at amortized cost. So I'm not really worried about the par value of these bonds, not yet. And then we're going to credit cash for that same $74,086. Purchase of debt. Now, in the next entry, we have to do the entry for the receipt of annual interest, assuming they receive interest as of the end of the year. So there are a couple of things that we need to calculate for this one. We have to determine the cash interest payment that we're going to receive, and we have to determine the interest expense. So I'm going to skip a couple of lines, and let's deal with the cash interest payment that we will receive first. This is where I take the par value of these bonds of $80,000 and I multiply it times 9%. And when we do that math, we get 7,200. And my formula is jacked up. There we go. Put my equal sign in here. And I'm going to use that number later. Let me label it as the cash interest payment received. Now let's find the interest revenue using the effective interest method. This is where I take the carrying value of my bonds and then I multiply it times the market rate of interest, which is the same as the rate of return that we are earning. So that 11%. Now, because interest is only paid one time a year, I don't have to worry about multiplying anything by half. All right, so I know I'm getting cash. And the amount of cash that I'm getting is determined by the 7,200. So I'm going to debit cash. Now, this is my interest revenue. So I know I'm crediting interest revenue. I'm the bond holder here. And that's going to be that $81.49. And of course, my entry doesn't balance. And I look at my entry and I say, ooh, how much more do I need and what side do I need it on? So I need more on the debit side, and let's see if that makes sense, because the account that I'm debiting is debt investments, my asset. And the reason why we're debiting this account is because at the end of the life of these bonds, the amortized cost, or that carrying value, has to be equal to the par value. So this 74,086 is slowly moving up to 80,000. So at the end of that 5-year period, when the bonds get paid off, we get $80,000 in cash, and we take the debt investment, $80,000, off the books. So we should debit debt investments HTM, and that's going to make that number slowly rise up to 80,000. So let me put in my description here to record the interest revenue on debt investments. And again, to calculate this 949, I just took the difference between the interest revenue and the cash. Let me take that down here so that when you go back to look at this, you're not confused. 7,200 was 949. I should put that here so I can be consistent. Minus this. And this is the amortization of the discount. All right, let's look at another one. Let me label this brief exercise 17.1. Now let's look at another one. I'm gonna copy and paste really quickly. So I can get my same formatting. And I'll delete all that stuff. The next one is brief exercise 17-2. And for this one, we need to use the information from 17-1. Oh, I shouldn't have deleted it. But assume the bonds are purchased as an available for sale security. We need to prepare Garfield's journal entries for the purchase of the investment, the receipt of the annual interest and discount amortization, and the end of year fair value adjustment. Assuming a zero balance in the fair value adjustment account, the bonds had a year-end fair value of $75,500. So when looking at an available for sale security, the entries are generally the same. So what you see here for held to maturity, we're going to do the same thing. The only thing I need to do is add an additional entry to write this up to the fair value. Or I may have to write it down. We'll see. Now, so I'm going to do a double work here. Copying and pasting again, because I have to do the entry to record the purchase of the investment. So I'm going to change it from held to maturity to available for sale. And I'm going to do the same thing down here. All of this looks the same. So I'm still finding cash by taking the par value times the contract rate of interest. I'm still finding interest revenue by taking the carrying value times the market rate of interest. And the difference between those two does give me the amortization of my discount here. The only thing that I'm changing is that this is available for sale instead of held to maturity. But now I need to do an additional entry here to do my write up to fair value, or write down the fair value. Now for this one, we are assuming that the fair value of the bond is $75,500. I have to compare this fair value to the carrying value of these bonds as of the end of the year. The carrying value is no longer the $74,086. Why? Because I've amortized this bond already. So I need to add in my amortization of $949. And I think it's $949.46, but close enough. I'm going to add those two numbers together. What's this? That gives me my new carrying value. So I'm going to compare this carrying value to the fair value. So my fair value is $75,500. And with that carrying value of $75,035, I am going to need to write this up. meaning I have 75,035 on the books, but it's worth more than that. So I do have an unrealized holding gain in this one. So now I'm going to take the difference between 75,500 and my old carrying value here. And 465 is my magic number. Now remember that the fair value adjustment account, it does have a normal credit balance. And right now on the balance sheet, I'm showing a balance of 75,035. I want the balance to be 75.5. So I need to add this 465 to the 75,035 on my balance sheet. So what does that mean? I'm not going to hit that account directly because I have to show that account at amortized costs. What I'm going to do is I'm going to hit my fair value adjustment account. Now, yes, it has a normal credit balance. So when I debit it, it's making it go down, but it is linked with the debt investments account. So that if this account has a debit balance of 465 and debt investment has a debit balance of 75,035, the combination of those two accounts is going to bring me to my appropriate fair value, of 75.5. So remember that this fair value adjustment account is it's simply a contra asset account, very similar to allowance for doubtful accounts. Now, I'm also crediting unrealized holding gain or loss dash equity. I can't forget that this is dash equity. We're going to credit that for 465, and it's not loss equity, it's loss equity. There we go. And then I add in my description here, and this is to adjust AFS to fair value. Now, this is brief exercise 17.2. Now, you know, it's never enough for me. We did a held to maturity. We did an available for sale. We have to do a trading security problem. And I don't think your book offers me one, but I can turn this one into a trading security problem. Let me show you what it's so much fun. I'll show you what I'm gonna do. Especially it's fun when you do it in Excel. Because when you have a trading security, all of the information remains the same as an available for sale security, with the exception of a couple of things. Now, we still are debiting debt investment, but we're going to call it dash trading, and we credit cash. We're still going to debit cash for the cash interest payment that we calculated down here. We're still going to credit interest revenue for the 8149, and the difference between those two will still be debited to debt investments, only it's not AFS anymore, it is trading. The last thing that changes is that I still need to do my fair value adjustment entry. But the difference is because it's a trading security, that unrealized holding gain is going to show up in income or in net income on the income statement instead of accumulated other comprehensive income on the balance sheet. So I need to change that to dash income, and we call that to adjust trading security to fair value. So in comparing all three, let me label this first before I forget to do this, and I'll call this trading so that you know what I'm doing. In comparing all three, we're using same numbers here. Held to maturity, fewer entries because there's no write up or write down in terms of fair value. Available for sale, same first two entries, but the third entry is different because you have to include dash equity. That write up for fair value is included in other comprehensive income. And for a trading security, first two entries are the same, only you're using dash income for the last entry because that adjustment to fair value is included in net income. All right, that was fairly short, and I'm thinking that you're going to find some of your other homework problems short as well. If you don't like the whole copying and pasting and you want the repetition of doing it over and over again so that you can solidify it in your mind, by all means do so. But in reality, a lot of the problems that you are going to see, they're going to give you the same information and then they're going to switch out whether it's trading, available for sale, or held to maturity as it relates to debt investments. So that takes care of the walkthrough video for debt investments. If you have additional questions or if you need an additional video, just contact me, let me know. I hope you have a great day. Thank you for your time and attention.